And Chair Powell, welcome back to the committee. When you last appeared before this, I also asked you about an expected Fed report on digital currencies. You indicated that delays in releasing the report were because the Fed wanted to ensure that their analysis was correct and to complete, and that a release was expected in the coming weeks. However, that report still has not been released. Do you have an update you can share on the status of the report? And are there problems with sharing this report with Congress and the public and what the Fed may be proposing with respect to possibly centralizing public digital currency?
So the report really is ready to go, and I would expect we will drop it. I hate to say it again, in coming weeks, but it really is in a situation where it's ready to go. The fall for us, given changes in monetary policy and other things going on, it was hard we didn't get it quite to where we needed to get it, but it's effectively there now. And I will tell you, it's within weeks we will be publishing it. And by the way, it's more going to be an exercise in asking questions and seeking input from the public rather than taking a lot of positions on various issues, although we do take some positions.
All right, thank you. Well, as I hope that you'll be able to meet this couple of weeks projection. As you know, I've been asking you and other members of the Fed about this for a long time, and I really do believe it's time that the Fed release this report so that we can engage in the further discussion of it. I want to also, with the rest of my time, go back to the issue of inflation. I know you've talked about it a lot with us this morning. In response to my questioning about inflation last November, you confirmed that inflationary pressures would certainly last, and you're through the middle of this coming year. What do you now expect with the time we've seen since you last answered these questions in front of the committee? What do you now expect inflationary pressures to look like throughout this year?
I wouldn't say things have changed much on that front since last November. I think that inflationary pressures do seem to be on track to last well into the middle of next year. And if they last longer than that, then I'll just say that our policy will continue to adapt. Our policy has been adapting to this, for some months. But if inflation is going to last longer, then that would potentially imply more risk of its persistence and ultimately becoming entrenched, and our policy will respond accordingly.
You just said well into the middle of next year. Did you mean this year or through all year and then next year?
I meant this year. You're right. I still think it's 2021 sometimes.
Hey, I thought so, but I wanted to be sure what you were saying. With regard to the question of what's going to happen over the next 3 to 4 months, as we try to deal with the inflationary pressures you've described, if consumer price inflation were to persist over the next 3 or 4 months at somewhere between 5 and 7%, as we are now seeing, and if the unemployment rate were to remain about where it is now, below 4%, what would you expect the tools that the Fed would need to use would be? And I noted in one of your responses on the inflation issue earlier today, I thought I heard you say that the Fed's overnight interest rate would still, even after you may use it as a tool, would still be very low. Could you just discuss I know you can't predict with specificity what the Fed would do, but could you discuss what you expect interest rates to look like as you utilize that tool?
Sure. So I think to your point, we're at a place where unemployment is now very low, historically low, and inflation is well above target, and the economy no longer needs this very highly accommodative stance of policy. And I would expect that this year, 2022, will be a year in which we take steps toward normalization. That will involve raising the federal funds rate. That will involve ending asset purchases in March. And perhaps later this year, depending on the run of things, we would also see ourselves beginning to allow the balance sheet to shrink. So that's what I think that's the broad picture of what I see happening. The committee hasn't made any decisions about the timing of any of that, and I think we're going to have to be both humble and a bit nimble here. If you go back and look at where where we were a year ago today in the economy. You know, vaccines were arriving. I think that in my thinking there was the idea that that'll really help us get past the pandemic, and it has helped a lot. But yet we're at all-time record cases and approaching record hospitalizations nationally. So the thing has stayed with us longer, and I think we're going to have to be open to the changing environment, and monetary policy is going to have to adapt as we learn more. And then we're going to learn a lot about the path of inflation, particularly as it relates to these supply-side blockages we've had over the course of the first 6 months of the year and every month, really.
So do I understand, are you saying that if the pandemic remains problematic and aggressive, that would impact the timing of any decisions the Fed might make in terms of the federal funds rate?
So I'd say it could, but you know, what's happened is the economy has made all these gains in the face of during 2021, we had two major pandemic outbreaks, two variant outbreaks, and really the beginning of 21 was dominated by a very strong wave of the original COVID. So, and yet the economy, we made tremendous progress in the labor market in 2021, and growth is at a multi-decade high in 2021. So I expect the economy to continue to be able to deal with these outbreaks. I think it is likely, though, if the experts are right and Omicron is going to go through really quickly and peak perhaps within a month and then come down after that, I think it's likely you will see you know, lower hiring and perhaps a pause in growth and that kind of thing. But it should be short-lived. It should be, and then the economy, the forecast for the rest of the year, or certainly for the next quarter or two, would be a very positive one, very positive.
And if that happens, would that increase the likelihood of Fed action to increase the federal funds rate, or would it delay that?
If that all happens, I think what we're seeing is an economy that functions right through these waves of COVID, and my colleagues and I see that, and you see that every quarter we write down projections of interest rates. They're individual projections. They're not a committee plan or anything like that. But broadly speaking, all members of the committee see interest rate increases coming this year. The median was 3. But that's going to depend on data. It's going to depend on the progress we see on the supply side, the progress we see on inflation. And we honestly don't know. There's risk on both sides, really, on growth and potentially on inflation as well. So we're going to have to be just very attentive to what's happening in the economy and willing to adapt pretty nimbly our policy as we go through the year.